So the small business deduction question is a good one. And that's where I need to, again, kind of distinguish between having a business. So we're talking about self-employed versus business income inside of a corporation. And it's only corporations that get that small business deduction. So the small business deduction is basically a rate reduction on your corporate income taxes. So where you have a business and you're earning that business, and there's a bunch of other criteria you need to meet. In that business income inside your corporation is profitable, the first $500,000 of it would get taxed at a preferred rate, the small business rate. And in Ontario, that's about 12.5%, roughly, depending on your year end. So that's the key. If you don't qualify for that small business deduction on your business income inside of that corporation, your tax rate in Ontario is 26.5% on all your income, or even all your business income above the $500,000 limit. So that's the answer inside of a corporation versus an individual who has business income. Well, they don't get a small business deduction. They don't even get a preferred rate of tax on their income from that business because they're just an individual. You get taxed as an individual, just like you would on all your other income sources like employment income or rental income or investment income. You're going to get taxed as an individual at the individual rate. It'd just be on business income after all your deductions, as you would have on your business inside of a corp. Your tax rate, though, is restricted to the individual personal rates, depending on where they lie, upwards of 53.5% in Ontario for an individual who's in the top bracket. A personal services business is it's a corporation that an individual has decided to set up in order to realize their employment income. So there's a distinction between having a self-employed individual versus an employee. Well, this is a personal services business is not a self-employed individual. Really, it's an employee who's decided to set up a corporation to put their employment income inside. So prior to having a set of rules in the Income Tax Act, going back many years, this used to be more common in certain industries so that people could avoid a lot of the payroll taxes that came along with having an employer-employee relationship. Somebody would just say, I decide I want to have my income instead transferred into a corporation. I mean, you probably are running afoul or running a risk of not being viewed as an employee, but it was a lot harder to catch if you were doing it through a corporation. So people would seek out corporations in order to realize their employment income in a corporation and take advantage of lower tax rates that a corporation pays on their income, their business income. Now we do have codified rules that say if you have a personal services business, which is essentially taking your employment income and putting into a corporation, well, you're going to be paying a really high rate of tax, about 44% in Ontario. And that rate of tax is the high rate of tax, and you're also going to be restricted on what you get to deduct inside of that corporation when you have a personal services business, because you're not a regular business. So we're basically going to allow you to deduct anything that a regular employee would deduct, not a self-employed individual, just a regular employee. So you're really restricted on like home office expenses, limited travel. And the only other one you get to have is, well, if you pay yourself a salary, you get to deduct that too. But in that case, you defeated the purpose of having the corp because now you end up with employment income anyway. So there's no real huge advantage tax-wise from having a personal services business. Because once you take that money out, now you got to pay that personal layer of tax, especially if you paid that 44% initially, and then you take out a dividend. Well, your overall effective combined tax rate is going to be over 66% when you have a personal services business. So it's usually ill-advised to go set one up. Selecting a year end is always interesting because that will depend on a lot of business factors. And I know income taxes get to play its part in influencing that decision. But, you know, we still have a lot of companies with year ends all over the place. And when you have a corporation you're able to select a year end for your business that is an off calendar, so at any point in the year. Whereas a self-employed individual, well, they're kind of stuck with the calendar year end for their business, which has to coincide with their personal tax reporting. So when you have a corporation and you're selecting a year end, I would usually start the conversation with what makes sense for your business. In other words, if you're going to realize, a higher amount of income, let's say in the fall, maybe you want to cut your year end off right before you have that bigger income amount. So you kind of want to push that larger income gain into the next fiscal year, and you get the benefit of a deferral instead of having to bring it in to income and pay tax faster. And, also in that vein, there's a lot of planning opportunities that can come along with a corporation where you're looking to pay your profits out to yourself. So, for example, there's the bonus rule, which allows you up to 180 days to pay out a bonus out of your own corporation. And what that means is, and I'll give you an example. Let's say you had a corporation with a year end of September 30th, and you had profits in the business of $100,000. Well, instead of paying taxes on the business's year end of September 30th on the $100,000, you decide to pay yourself a bonus out of that profits. So effectively, we reduce the profits in the corporation to zero, pay zero tax, and I'm going to receive a bonus in the form of a T4 that I'm going to include in my personal income. Well, the rules that I'm referring to allow the corporation to take that deduction in September right away, whereas the individual receiving that bonus doesn't necessarily have to receive it on September 30th or October 1st or even December 31st for that matter. As long as that individual receives that bonus payment within 6 months, so before the end of March of the following year, that individual can now deflect some, part, all of the taxes to the next calendar year, so they don't have to pay taxes in the corporation or even in the calendar year as an individual, because they can effectively push it to the next calendar year and get a big deferral on the taxes on that initial $100,000 income. That's something you don't get as an individual who's self-employed with a business. You need a corporation in order to achieve that result. GST and HST. Yeah, that's boy, oh boy. We have experts for that too. I mean, I'm not a GST or a HST expert. We have a whole team of people at BDO that deal with that. I'm a Canadian income tax expert, but I mean, it's hard not to deal with both. Whenever you're sitting down with a client, I mean, they come up hand in hand all the time. It doesn't matter the issue. Typically, small business owners view them the same. I mean, it's a tax issue I need to deal with. So it can vary. And what I usually see in practice is getting an understanding of what you're providing in terms of services or product. That's the key, understanding that, because from my time as a practitioner, what I've discovered is that GST rules vary across the board, and there are quite often exceptions, and then exceptions for the exceptions, and then exceptions to those exceptions. So depending where you fall, and then there's time limits and all sorts of restrictions and conditions in between, you might not be taxable, or you might be collecting tax in error, or you might not have to collect tax at all and are entitled to credits. And it can be an overwhelming sea of endless compliance and understanding that, I just defer to the expert, even as an income tax expert, because I don't have the time or the ability to understand that, let alone clients who are struggling enough just trying to run their own business. So getting a thorough understanding, which we can provide advice on, the facts, and looking at a particular situation will probably put you in the best boat before the government comes knocking and does that analysis for you. You want to make sure that you're taken care of and you're collecting that tax when you're supposed to, registering when you're supposed to, and claiming the credits that you're entitled to so they don't fall off the table. One thing I have seen before is practitioners who may not have otherwise registered for GST because they figured, well, anything medical related is always exempt, right? It's all GST exempt. That's what I've heard. well, then they don't go out and register. Meanwhile, when they start analyzing the actual services of their practice or the ancillary products that they might provide outside of the core medical services, even if they fall in that category, like I said before, there could be exceptions and exceptions to the exceptions or certain carve-outs. And that could come down to just your record keeping alone that might entitle you to certain benefits or recoveries of taxes in the form of credits on your own expenditures that you wouldn't otherwise be able to claim unless you were registered in the first place. So, it's a very complicated web of rules, and that's why we have a whole team of experts to deal with it. And I encourage all startup businesses in any area in Canada, as long as you're tiptoeing into Canada, you want to make sure that you're covered on the compliance side with respect to registering and dealing with your GST matters. And it does require an understanding of the facts up front so that you kick it off right and you don't get into trouble down the road. Providing taxable health services and non-taxable health services in combination with taxable apparatus or equipment that might be ancillary to those services, or non-taxable ancillary products or services in connection with your main core services happens all the time. And it's quite often found in the health industry. And quite frankly, it happens in many industries. And it's an understanding of the rules. And going back to, I know it sounds kind of cliche, but you need an evaluation to get in there to understand what you're doing so that you can position yourself ideally in order to not have money fall off the table and not get in trouble with the government in case you are treating something or part of something incorrectly. And that can come down to sometimes how things are bundled and invoiced or billed to a customer, or perhaps how they're sold, if they're sold separately. There's a lot of issues and variables that go into trying to determine how and what gets taxed. And it's something that is best left to the experts to advise, for sure.